I think the most important way to think about it is in rate of change terms. And that's kind of the biggest disconnect that I think some people have, where you have to take into account both magnitudes and rate of change. So basically, last year, of course, we had this massive deflationary shock. You had a lot of demand destruction from lockdowns and the pandemic and things like that. So we printed a ton of money, and that's the combination of fiscal spending and then the Federal Reserve creating new base money to buy most of those bonds. And so that, unlike, for example, just doing QE alone, that money did not just stay in the banking system. It actually got out to people's bank accounts. It went out in the form of stimulus checks, unemployment benefits, PPP loans that turn into grants. In most cases, they get forgiven. Extra unemployment benefits, all these different kind of, policies went out. People got checks in their accounts. So, people's checking accounts, savings accounts went up. And so you had that kind of weird dislocation where fewer people are working, and yet their income's actually above trend for a period of time. And so, but for a while they couldn't really spend it. They couldn't really travel anywhere. They couldn't do it a ton, right? So they mostly just saved it. They bought extra subscriptions and things like that, but they really didn't kind of circulate it too much. But then as things started to open up in later parts of 2020, and then especially here in 2021, we're seeing that money kind of pour back out into things. We're starting to see all sorts of, shortages from, people were off of work for a while. And then also there were kind of like weird demand dislocations, right? So more people bought homes all at once. And so we had lumber issues like sawmill bottlenecks. We had semiconductor shortages. We still have those taking place. We have shipping issues, right? So there's only so many container ships and containers out there. And you had kind of dislocations in shipping. And so when you have the combination of a lot of increase in broad money supply at the same time as there are really real constraints on some of these supplies and services, goods and services, you start to get price inflation in some of those. And then in addition, we've seen start to have kind of like wage inflation creeping up a little bit, partially because people have been given pretty big benefits, whether they're working or not. And so basically, if you're a business that wants to lure people back to your workforce, you're in the position where you have to kind of do bigger sign-on bonuses or wage increases in order to kind of maintain that labor. So we've had some labor shortages, especially in kind of the service sector jobs. And but I think one of the things now is that we're experiencing a pretty high level of inflation. So official CPI hit 5% roughly this past month. And right at the peak where everyone's going to talk about inflation, what's probably going to happen actually is we're going to roll over a little bit because the base effects are a little bit harder as you go later into the summer, and some of those stimulus effects are kind of gradually wearing off. I'm still long-term bullish on them. It depends. Again, I think they're going to come in cycles. And so if you look at gold, for example, gold, real rates as measured by the 10-year treasury minus inflation break-evens, which is like the tips markets, kind of forward inflation expectation, which isn't even a great measurement because the Fed's buying tips, right? So when the measurement when like the measurement becomes a target, it ceases to be a measurement is the example. But that's they're all paper markets. So the gold paper market follows the inflation paper market. And so basically when you look at say 10-year treasuries minus the 10-year break evens, that's the real yield that the gold market has the closest correlation to. And for example, that hit a low back in August 2020, and it's started to rise, and then it kind of rolled back over, and so it's kind of come back down, but it's never really gotten to lower lows yet. And so because we've had inflation break evens rise, we had nominal yields rise as well, and so we've been in this kind of choppy pattern for gold, which makes sense when you look at the real rates argument. And so over time, I think the 2020s are likely to be in a period of persistently negative real rates. I do think we'll probably see a period where we go into lower negative rate territory than we saw in August 2020. I just don't know if that'll be in say this year or not. But I do think as you look out further, that's certainly a place I'd want to have some of my assets in gold and gold miners, and probably silver as well, because you're still looking at a period of cash devaluation, bond devaluation, and so I think those are nice hedges. In addition, if you look at say gold and silver miners, they're actually pretty attractive with current gold and silver prices. And so even if you're kind of lukewarm on the underlying metal, and you think, okay, let's say gold and silver go flat and choppy for a year or so, those miners in many cases are making pretty good free cash flow at current levels, and they're not too expensive on a price to free cash flow basis. And a lot of them have plowed that free cash flow instead of, if you look back in 2011, a lot of them were whatever money they had, they would just spend it in more capex or they'd make acquisitions. And a lot of them didn't really produce a lot of free cash flow, even though they had really strong markets in their underlying metal. And now what they're doing is they're basically just all the profits that they're getting from those higher prices, they're paying off debt, they're strengthening their balance sheet. Some of them are paying dividends to shareholders. And so in many ways, the gold and silver stocks have better balance sheets and better free cash flow than they've had in, modern history. I like to use the 40s as an example, 1940s, because you had very fiscal driven inflation just like now. You had an external catalyst. It was a war instead of, pandemics and shutdowns. But it was kind of actually a similar, phenomenon in terms of where we were in the long-term debt cycle, the type of politics that were happening at the time, kind of that populist versus establishment, change happening. And there's a lot of kind of similar factors. If you look at, say, the fourth turning, type of social analysis, it was the last time we're in a fourth turning. And basically, what we saw in the 40s, for example, is you would see these spikes of inflation, and then inflation would cool off, but it wouldn't deflate afterward, right? And so that'd be a permanent stepwise increase in broad prices. And that doesn't mean every single price goes up and stays there. For example, you could have a copper shortage, copper spikes and then cools off, right? But in general, broad prices went up to a higher level and then stayed there. And then they would stay there for a couple of years, and there'd be another big fiscal impulse, another big spike, where changes and kind of the wage and price controls. You'd have another big spike in inflation, and then that would cool off. It wouldn't really deflate afterwards, so you'd have another stepwise increase. And so my overall base case for the 2020s is we're looking something like that, where what we're experiencing now is mostly a stepwise increase in a number of prices. And there are some things that can and will come down from their peak. Like, for example, in my main newsletter, I talked about lumber is, probably not going to stay as high as it was, and it's already in fact come down significantly. The question is, will it come all the way back down to its starting point? I don't think so. But even if that does, my base case is essentially that a broad enough section of prices, ranging from commodities to goods and services and wages, they might not keep accelerating the same pace they were, partially because of the year-over-year base effects get harder, and because some of that fiscal, that money that kind of injected into the economy starts to wear off. But that a lot of the price increases that we've seen, many of them will be permanent. And then the big question later on is, when that starts to cool off, if the economy starts to cool off, will fiscal policymakers pass another bill of some sort? Could be an infrastructure bill, could be something else, and that could give us another stepwise increase. But of course, we have to watch that policy outcome. And I think the other variable to watch longer term is energy markets. And because the past more than a decade, we've been in a period of commodity oversupply for the most part, until this past year, we started to see some commodity shortages. But then particularly in energy markets, that's where we've had the most abundance in terms of supply versus demand. And so even last year and this year, we had, for example, a significant amount of OPEC spare capacity. But because prices have been low for a while, then now they're starting to heat back up. But because energy prices have been low, and then especially also when you layer on ESG concerns and things like that, there's actually not a lot of capex going on in oil and gas. And so when you look out kind of a few years, the oil market looks a lot tighter. And so I wouldn't be surprised to see higher oil and gas prices when you look at a few years. And I think that is another catalyst to give us a later spike in the future.